We are back in the black hole of real estate, and I want to spend some time today talking about what's going on with first time home buyers and how it's harder for them than it's been in many, many years to purchase a home, and a lot have given up some hope. And I want to shine a light on what is possible to do today, and is there a light at the end of the tunnel? This is Ron Wojciechowski for the black hole of real estate. And if you're a first-time home buyer or know someone in that situation, it's a bit of a daunting process right now. Inflation is really eating into family budgets, and the interest rates are much higher than they were in the past. And many have given up hope. They feel as if there's really not something they can do right now to get themselves in a home that they could own. And when you look at the rent rolls, such that they are today, the rent of the home that they're living in many cases, is actually more than the mortgage payment would be to own the same house. And it sounds crazy, but it's the truth. You would think it'd be the other way around. If you go back a few years when the rates were low in the 2s, 3s, and even 4s, the prices of the homes were lower, and it was more affordable on a monthly basis because the interest was lower. And you fast forward to now where the prices are much, much higher and the rates are much, much higher. It's putting a pretty big gap in between the ones that were fortunate enough to take action and purchase, say, 3, 4, 5 years ago, and the ones that are just trying to figure it out today. And while I don't have the total solution, I can at least identify the situation we're in and offer some guidance and assistance to those that are really looking to make that purchase, but frustrated or just really not sure how to approach it. So the first thing I'm going to say is that if you have an interest in purchasing a home, take a look at your credit. Is there something that you can do to get your credit score as high as possible? For some, it's already there. They just don't have the down payment. But let's start with the credit. If you have consumer debt, so that would be student loans. If they're in deferment, okay. If they're not, okay. But if you have a student loan, you'll need to take that into account, and a lender can help you with that. If you have a car payment, that will count against you as far as your debt-to-income ratio, which we can talk about. But if you are looking to buy a home, I would avoid buying another car on top of that or trying to refinance the car loan. If you're in the last 10 months, a lot of times the lender will not count that car loan debt because you're almost done paying for it. So if you got about a year to go on a car and you want to buy a house, it's advisable in most cases to hold off on the car purchase. Or if you don't have a car loan, don't get one right now. Get the house first, then take care of the car. It's much easier to qualify for a car loan. It's typically on your credit score and a stated income. It's a lot easier to qualify for that than it would be for the house. So student loan, car loan, those are installment debts. Those are things you got to look at. If you've got a different mortgage and you're looking to buy an additional home, you may be able to use some rent against it to deflect off that cost of the mortgage every month. You've got some rent coming in. Those are the big installment loans that you have: mortgage, car loan, student loan. Those are the big ones, unless boat loan, I guess. But I digress. The revolving debt. So your credit cards. If you're using up most of your credit card availability, it's going to tank your score pretty dramatically. If you have 10,000 available credit and you're using 9,900 of it, that's going to negatively reflect on your credit score. So if there's a way to avoid having consumer credit card debt, great. Credit inquiries. It's the holidays, my goodness. Everywhere you go, they're going to ask you to open up a new credit card. All those credit inquiries are going to do a couple of things. Number one, it's going to show that you're trying to borrow money when maybe you're just trying to save 10%. But the algorithm suggests that if you're getting new credit, that you're going further into debt, which they would look as a negative. The other thing is that it's going to reduce the average age of your credit. So if you had two different credit cards that are 5 years old and a car loan that's 5 years old, the average age would be 5. But if you add a new one to it, that's a fourth trade line, and you're going to take 5 years times 3 is 15, plus 1 year, 0 for the new one. So now you've taken your average age of your credit from 5 years down to like 3.5 or 3.25. So that would also make your score go down. So the inquiries are going to work against you. The consumer debt's going to work against you. And you need to hear that first. So if there's something you could do to work on that or avoid a major purchase right now, that would help you in the mortgage qualification. Your debt to income, that's whatever you're making, and divide it up by what your debts are. So installment debts, your revolving debts, things like that, and the new mortgage. They're going to want that to come under 45% of your total income. That's gross income, not after taxes. We can spend more time on that in a different show if that's something that people want to write in and ask questions about. The other thing is your down payment. Have you been saving for a down payment? If you're in the military and you have the DD-214 and your eligibility certificate, you had an honorable discharge, you might qualify, could very well qualify for a no down payment loan. The seller could also help you with the closing costs as well. So that is a path to ownership with very little money out of pocket. FHA is extremely popular, and a lot of people call it the first-time home buyer's loan. Well, a lot of people that are first-time home buyers use an FHA loan because the down payment is 3.5%. So that is absolutely a way to go. If you're looking at a $300,000 home, you need $10,500 for down payment. You would need money for closing costs. It could be $15,000, $18,000, probably under $20,000. Now, the down payment can be a gift from a family member, direct family member, but you can't advance it against a credit card. That doesn't work. It can be a gift. The other side of it is the seller can help pay for closing costs, and then it helps wash out some of the cash needed at closing. So the other thing you might find is a credit union might offer something with a 3% down payment. So if you're a member of a credit union, check into that as well. That will get you on there. So your credit, and then of course your mortgage qualification, and saving for a down payment, super, super important right now. And if you can overcome those things, that gets you heading in the right direction. Certainly, start studying homes online. If you're going to use an agent, that would also be something you're going to want to look at as interview agents, or at least get yourself educated on what questions you would ask and what would be important to you in the process of purchasing a home, especially when it's your first time. You don't need to know a lot about insurance up front. Just know that as part of the process, if the home is in a flood zone area, that could increase the age. Not the age. It would increase the cost of the insurance because there's more risk if it's in a flood zone. The age of the roof is where I was heading with that, could also affect that. So if you're looking at an older home with an older roof, that insurance could cost more than a newer home with a newer roof. And risk factors are what increase the amount of the cost of insurance. So a skilled agent would be able to advise you on which homes might have a lower insurance rate. And that would also affect you in a way that's really good after closing. If it's a newer roof and the plumbing and electrical are all in good shape, and so is the HVAC, then you're probably not getting a big ticket repair shortly after you bought the home, and that might help you save some money to when those eventually have to be replaced. So those are super important to be thinking about as you're looking at homes, the age of the home, the condition, what money will you need after closing for any potential repairs or remodeling. And the last thing I'm going to say is, as you talk to lenders, there is something called a 2-1 buy down program. So when they say 2-1, 2-1, so it's 2% lower interest rate the first year, 1% lower in the second year, and the savings could amount to a few $1,000s, and that can also be something that you ask the seller to pay for as part of a negotiation. So if they were to prepay $3,000, $4,000, $5,000 worth of interest, and let's just suppose that rates were 6.5%. The first year, the payment would be based on 4.5%. The second year, the payment would be based on 5.5%, and then the third year would be the 6.5%. So the 2-1 buy down is prepaying some of the interest to make the monthly payment lower, and you could pay that out of pocket if you have the money, and you need to fit within a payment for qualification based on your income, your debt to income ratio. And then it can also come from the seller to help pay for the closing costs. So a couple ways to get that. The last thing I'm going to say is, when you're interviewing lenders, find out if they have a loan interest rate reduction program. A VA has what they call an IRRL loan, IRRL, interest rate reduction loan. What happens is, in a VA, when the rates eventually go down, you can apply to have the rate reduced, and it automatically will move lower. So that's something, if you have a VA loan, something. Just look for the EARL loan and ask them how, when can you refinance down to the lower rate. The other thing, a lot of lenders now are having some sort of a program. I know that we work with one where for up to 5 years, they will refinance the loan down to a lower rate with no lender fees. Now, keep in mind, there's probably some closing costs for the person, title agent that's closing it, and then there may be also some amounts of money due to the city and county for things like doc stamps and intangible taxes. Your lender could tell you about what those costs would be. But as far as the lenders, certain lenders are waiving all of their fees for up to 5 years. So if the rates go lower, if it's 6.5 today and it's 4.5 in a couple of years, you'd be able to float down to that rate at a minimal cost, which could sometimes be included in the new mortgage balance. And what that means is that you may not have to take much money out of pocket to get down to that lower interest rate. So there's some really good things out there for a home buyer that might be frustrated, especially first timers. So if you're looking to get into home ownership, fix the credit if it needs it, but definitely take care of your credit and limit the new inquiries and the big ticket items. Avoid the new car until you get the house. Absolutely work on your savings for your down payment. If you have a program through work or your 401k or a gift that can also help you, I would look into that. And then finally, when you talk to the lenders, inquire about 2-1 buy downs and find out when, is there a program available to refinance down to when the rates are, lower than they are today. The main thing is, if you want to purchase a home and you're a first-time home buyer, there's a path to ownership out there for you. It will require some diligence, yes, a little bit of sacrifice, but the end benefit is super important and really great to have home ownership as part of your life, but also for your wealth building strategy. I hope this has helped you out today if you're a first-time home buyer. And if you got questions, drop them below or direct messages, and we'll make sure that we address you individually or make that a future story for one of our podcasts. This is Ron Wysokarski for the Black Hole of Real Estate.